Hello, everyone, and welcome to today's webinar. This is Channel Vision editor Gerald Baldino here, and today we're very excited to feature the experts from Wolters Kluwer CCH Suretax and Blue Logics for a presentation on monetization and tax compliance with as-a-service offerings. Today we're with Tim Cook, founder and recurring revenue evangelist at Blue Logics. Also joining us is David Rubenstein, who is senior telecommunications tax specialist at Wolters Kluwer. We also have Peter Pekar, who is Senior Consultant of Global Content Assets at Wolters Kluwer, and Andrew Daly, Managing Director at MGI Research. Please stay tuned for a Q&A session at the end of the webinar. If you have any questions during the presentation, you can submit them through the Q&A portal located at the bottom of the Zoom platform. At this point, I'd like to turn the presentation over to Tim to begin. Tim?
Thanks, Gerald. I appreciate that. So I just wanted to kind of say a few words about the inspiration for this webinar. Really, the webinar is inspired around the fact that as solution providers move their solutions to internet accessible portals, we're seeing that they're finding access to global markets. And with this, these companies are often struggling to understand how to address these markets from an operational and financial monetization perspective. So with that, we've brought together some experts from the industry. I'd like to hand it over to Andrew Daly from MGI.
Thanks, Tim, and welcome everyone. For those of you who don't know MGI Research, we are an independent research and advisory firm founded in 2008 by former executives and top-ranked analysts from companies like Gartner, Morgan Stanley, SoundView, and MasterCard. We serve finance, business, and technology buyers within enterprises, as well as technology CEOs and CFOs and institutional investors. We have a specific focus and analyst teams doing research on what we call agile monetization, which simplistically is really a modern view of the quote-to-cash process. Our research methodology is quantitative and highly structured, and clients around the world use our research to help optimize and improve their monetization capabilities. We publish company ratings, research scenarios, market forecasts, market maps, and host conferences focused on innovation in and around monetization. We have also developed a franchise in the area of software and internet company valuation models. So overall, during the course of any given year, we speak with hundreds of companies and individual business and finance execs. And we also lead the Monetization Leadership Council here in Silicon Valley. So nearly every business publication or management consultancy tells their audience that global markets are the way to riches. We agree. Expanding a business into international markets is a solid strategy. In practice, though, reaching into global markets exposes the limitations and the limits of monetization capabilities for most companies. This applies to billing international clients, managing global revenue recognition, collecting taxes, administering local payment methods, providing support across time zones and language and cultural barriers, and staying in compliance with local regulatory mandates. So in our short time here together today, I'm going to present an approach to benchmarking your global monetization capabilities and begin to detail kind of the internal and external resources that successful organizations have on their team. And at the end of all the presentations here, I look forward to answering some of your questions. So, weighed down by challenging demographic trends, sizable debt, and social obligations, the developed economies are growing much slower than those in the emerging markets and are seeking export markets with rising per capita GDP. That was true in the pre-COVID era, and it's even more true, as I'll detail here in a minute, today in light of the COVID pandemic. On the other hand, the developing economies, especially in smaller countries, are seeking access to larger global opportunities as well. And over the last 20 years, what we've seen is that internet adoption and the explosion in mobility have really catalyzed global trade and accelerated its growth. So the business case for global expansion is strong. The underlying growth drivers are very durable. And yet, while trade information now frees flowly, the global money flows remain not only complex and fragmented, but are often a serious gating factor to success in international expansion. Most companies simply lack the tools and expertise in taking even basic digital subscriptions to global markets. And as I mentioned earlier, in the COVID area, profitably reaching new geographic markets is even more important than ever. The latest forecast from the OECD pegs 2021, or rather 2020 GDP growth, so that's for this year, at 2% for China, -1 to 2% for South Korea, -5% for the US, and the Euro countries and Britain are at -8 to 10% respectively. And those numbers came out before we've seen the latest round of lockdowns in kind of the second wave of trying to mitigate the transmission of the virus. So companies that are able to access markets beyond the US and beyond Europe will clearly be at an advantage. And as I mentioned, often the barriers to market access are associated with an organization's monetization capabilities, such as being able to handle foreign payments, proper tax and tariff handling, and the ability to invoice accurately in local languages. And last month, we saw that the British government indicated restrictions on movement and economic activity may stay in place until March or even into the second quarter of next year. And we're seeing an increased wave in these government initiatives to limit the circulation of people and slow the transmission of the virus. So a prolonged pandemic coupled with increasing geopolitical risks and the absence, at least as of today, of additional federal stimulus spending translate into what is at best described in the US as maybe a 90% economy, or maybe it's an 80 to 85% economy. So reaching beyond the home market should be a priority for every company seeking to achieve its objectives in 2021 and in 2022. And on the screen, you see the key issues kind of facing companies that are either looking to go global or who are already in multiple geographic markets and are looking to improve upon their performance. So I won't go through each one of those, but we can start to look at in the next slide in terms of how we begin to look at, sorry, if you go back one slide. Yeah, so we recommend that companies who are contemplating a global expansion conduct a review of their international monetization capabilities. And at MGI Research, we developed what we call the GM17, or the Global Monetization Capability Assessment. It's got 17 individual points. I've summarized them to 14 to fit onto the slide here, but you can go through each one of those. And what you see is this is really designed to challenge kind of conventional assumptions on what works, in that what works in one country may or may not work equally well in others. And without proper planning, the diversity of regulatory, payment, and tax regimes across the world really can be overwhelming for a lot of companies. For example, there are laws in many individual countries that prohibit parent companies overseas from issuing explicit edicts to local affiliates. Some geographies are now experimenting with essentially a real-time reporting of revenue and tax calculations, for example, in Spain and Brazil. And then there are the local payment methods and payment processing options. So simply assuming that everyone around the world can pay via credit card, and therefore that it will all work, usually that leads to pretty severe disappointments. And so alongside each one of these areas of capabilities, our assessment asks over 50 questions probing into these individual areas. And these questions can be used to frame the conversation internally and to help catalyze an effort to improve capabilities and to fill in some of the gaps that may exist in customer experience and some of the financial and regulatory gaps that may exist in your organization. So you might also ask the question, why take the time to inventory capabilities and benchmark your monetization performance? And the answer to that is in 2 words: revenue leakage. MGI Research estimates that revenue leakage within North American companies, on average, is between 2 to 5% of revenues. It's not uncommon for international revenue leakage to be 25 to 50% higher than domestic leakage. And we expect that between 2021 and 2025, organizations that modernize their global monetization systems and adopt best practices will see a 25 to 40% reduction in their revenue leakage. And the reductions internationally may be even higher. So we strongly encourage everyone to take a look at a way to assess your capabilities in these specific areas, and then to look at what is your monetization team. And when you look at the monetization team, it's really about bringing together not only your executive sponsor, finance, and IT, but bringing together what we call the global monetization team, which is product management, customer service, legal, compliance, regulatory folks, your internal tax and internal audit, as well as expert consultants and some of your core suppliers. And what we've seen is that no organization can be kind of world-class in everything. And we really rely on our suppliers and external consultants in specific areas to provide, if you will, that last mile of deep domain expertise that really can make a difference between being successful or not, or plugging revenue leakage or not, or being in compliance or not. And so when it comes to going global and monetization, having that team of specialists really makes, so to speak, a world of difference in terms of overall performance from what we've seen in benchmarking companies. And so with that, speaking of domain experts, it's my pleasure to introduce the next speaker, David Rubenstein, who's a tax specialist at CCH Wolters Kluwer and has over 25 years of deep industry experience. So David, over to you.
Okay, well, thank you for that. Taxability of software as a service in the US. So first of all, SaaS defined. Software as a service is an online software model where software is hosted in one place and accessed remotely for use by customers in another. States differ in their tax treatment of SaaS. It's not uniform. Every state in effect is its own country. So unlike, let's say Europe, each country has its own VAT rate, and that's it. That's all you have to deal with. In the US, every state is equivalent to a country. It has its own rate, its own rules, its own, and we're going to see the establishment of Nexus. So you have to deal with each state as if, in effect, they were their own country. Now, some states consider software as a service taxable. About half the states, by the way, tax it. Some tax it as software, despite the fact that it's not delivered tangibly, meaning that you're accessing it remotely. That presents a potential tax exemption in many states because it's not tangible, do not tax it as software. Other states consider SaaS to be a service. And those states, about a quarter of the states who do tax services, would apply tax as SaaS. So what does that leave us? Well, it leaves us that many states don't tax software because this type of software because it's intangible. It then falls under the service category. Most states don't tax service, so therefore that's where SaaS falls out of being taxed. About half the states. Again, half do, but ultimately, your taxation of SaaS is going to be dependent on whether you have nexus to that particular state. Now, what is sales tax nexus? Sales tax nexus defined refers to a connection between a seller and a jurisdiction. In this case, we'll be speaking mainly of the states because the states are the ones who typically administer the sales tax. Now, you could have multi-level, we do have multi-level sales tax, so we're not only dealing with sales tax on a state level, there's also state and there's counties that have their own sales tax, their own rate. There's cities that have their own cities rate, especially the larger cities for sure. And then there's special districts, fires, the school districts, stadiums, etc. But a lot of states streamline it so it's all reported to the state level, and therefore, and the only exception to that, well, the main exception to that would be home rule, where the cities have their jurisdiction over their own sales tax. So it becomes more of a reporting issue, but the reporting is not going to always roll up to the state. It may not roll up and be done at the city level, or for example. Now, going back to Nexus. Nexus created by your business having presence in a jurisdiction. This needs to be determined state by state because states have different rules what creates nexus. So not only do you have different rates and, well, different tax rates for each state on the sales tax, different levels of sales tax with different rates, different rules state by state, but you also have each state having their own nexus rules. It's not uniform one state to the other what creates nexus. So you may be doing business in 15, 12, depending on what your footprint is in the US, 15 or more states. Each of the states will have to be looked at to determine what their nexus standard is. Then you'll need to compare that to what kind of activities you have in that state. Now, certain business activities, such as having physical presence or reaching a certain annual sales threshold, can establish nexus in a state. There was what's called a Wayfair case, which was back in June of 18, and that decision had a major impact on nexus rules because it established a nexus rule based upon economic threshold. And by doing that, it eliminated what was used to be purely mainly a physical presence. Now, we didn't get rid of physical presence. Certainly, if you have physical presence in the state, if you have brick and mortar, if you have an office, you own an office building, you have salespeople there, that would establish nexus. That's simple. But if you're an online service, so then it was going to more probably focus on what your economic presence is there. So most states indeed have adopted economic threshold. Again, not uniform one state to the next. These thresholds vary. So please consult your tax advisor to determine your sales tax nexus. Now, the U.S. tax in general, we discussed a little bit multi-layered jurisdictions. These are called tax authorities in our system. Each tax authority, whether it's a federal tax authority, a state, a county, city, special jurisdiction, they operate independently of each other. So even if your country has a federal tax treaty with the U.S., that would not be binding on a particular state, so that the state could impose not only direct tax of income tax, but also indirect tax of sales tax. That federal tax treaty, which would exempt federal income tax, has no impact on the state level. But we do cover in the Suretax database all the rates and rules for sales and use tax, for every location throughout the U.S. and territories. You won't need to register, by the way, with the Federal Communications Commission. So even though we discussed federal jurisdiction, that doesn't come into play when you're specifically offering either software as a service or similarly platform as a service or infrastructure as a service. These kind of services do not require registration for tax purposes of the FCC, whereas telecom does. However, you must register with every state where you do have Nexus, and registration is key. That's what drives your compliance. Now, intricacies of SaaS, well, who the customer is plays a role in determining the tax treatment of SaaS. So whether your customer is just an individual user, let's say of your platform, whether they're be it like a residential customer, or they might be a business, and you being a business and they being a business, well, that would result in what we call B2B. Now, the states of Connecticut and Iowa, they began to fully tax SaaS, but they carved out exceptions for B2B. Connecticut applies a reduced sales tax rate of 1% instead of the regular rate, which is much higher for B2B sales, and Iowa exempts B2B totally. So they will but Iowa taxes SaaS for residential customers, individual users, but not for a business. Now, should you be concerned about compliance? We've laid out a lot of different nuances and intricacies within tax schema in the US. No, you shouldn't be concerned when you're using a platform such as BlueLogix that's integrated with a tax calculation solution like Suretax. That's going to provide you with all the rates and rules you need. You do a simple mapping of your service to our tax codes, and you'll get all the results and compliance that you need around that. And with that, I'd like to hand over the baton to my esteemed colleague, Petter, who's going to talk about VAT implementations for US-based providers who are expanding globally.
Thank you, David. So as David said, I'm going to speak to you about what software as a service or anything as a service providers that are based in the US need to look out for from a VAT or GST perspective when expanding their business into countries that have VAT or GST in place. Now, I will be using the terms VAT and GST interchangeably. There are some differences between the two and from country to country, but broadly, we can consider them as being one and the same thing for the purposes of this webinar. Where there are not many differences, however, is among European Union countries. And this is because the system of value-added tax is harmonized in the EU. So pretty much everything that I'll be saying applies in the same way to all European Union member states. And although I'll be basing a lot of my presentation on European Union VAT, the basics tend to also be relevant globally. So while there is no harmonization or uniformity among non-European Union countries, still other jurisdictions internationally tend to model or gradually adapt their VAT or GST systems in line with that of the European Union. So we cannot speak of this subject without going into the place of supply rules. Now, what are these? They can be assimilated to the interplay between Citus and Nexus in North American sales tax. So the place of supply rules, they seek to reply to these questions. Where is a sale deemed to take place for VAT purposes? And which state has the right to apply VAT or GST, as I said? The general rules for B2B are that B2B sales are deemed to take place in the buyer's location, whereas in the B2C scenario, they are deemed to take place where the seller is based. Now, as with every rule, we have exceptions, and these most notably include the B2C exception to telecoms, broadcasting, and electronically supplied services, which are taxable in the buyer's location. Now, this is the destination principle. Now, for SaaS or anything as a service, we have to consider the rules for e-services. In fact, this ties in with the exceptions that I just mentioned. There is special treatment for digital services, the destination principle. And this is because with globalization, digitally provided services become easily accessible from everywhere. And if these services were taxed in the seller's location, it would create an imbalance and a competitive advantage to jurisdictions with lower indirect taxation. Now, what do these e-services include, or digital services? Again, I'll be using e-service, digital services interchangeably. Based on the EU VAT directive, these include the types of services you see there: websites, web hosting, software and updates, images, text information, music streaming, and so on. By its nature, software as a service or anything as a service would, in many cases, fall within the scope of electronically supplied services. These will also include accounting or tax calculation solutions, translation software, antiviruses, but even consumer music and video streaming services, which would in most cases be B2C though. So the next thing to tackle is the treatment, the B2B treatment of VAT and GST. Now, I'd say that this is how most of our audience does their business, that is B2B. But if there are any of you who are B2C providers, don't worry, I will address that as well in the following slide. The B2B scenario is the less problematic one of the two. This is because VAT can only be complied with by a VAT-registered business. Consumers cannot comply with VAT. Consumers just pay VAT on their purchase, but then that VAT has to be remitted to the tax authority and a VAT return has to be filed. And it's not the consumers who do that, it's the businesses who do that. So let's have a look at what happens with remote sales, okay, which is the most common way that SaaS is sold. So with remote sales, B2B, there is a tax shift. So we already spoke about B2B supplies being taxable where the buyer is based. Now there is a simplification in place with VAT, which allows compliance with VAT to be shifted onto the purchaser, okay? You might have heard of the term reverse charge, and this is a bit similar to it. And it applies to remote sales of digital services coming in from outside the jurisdiction. So how does it work? The way it works is that the seller, so if you're based in the US, you do not charge any VAT on your sales invoice. The customer, on the other hand, the customer based in Europe or some other country internationally, self-charges the VAT, the output VAT on your behalf at the rate applicable in their location, and concurrently reclaims that input VAT, the same amount of input VAT. And this makes the transaction neutral for VAT purposes. So essentially, if we're talking 200 euros output minus 200 euros input, so the result is zero, it's neutral for the purchaser. However, they need to declare all of this in their VAT return. The result is that the seller avoids having to register for VAT and avoids having to comply in any way with VAT returns and so on. Now, for the sake of completeness, and possibly for those with physical locations in foreign territory, I also thought I'd mention what happens if you're selling locally. And if you do that, if you have a physical location, that's where the VAT obligations kick in. Okay, because having a business location in the foreign territory generally triggers the obligation to register, to start charging VAT, and to comply with local VAT laws. Okay, now this may be subject to registration thresholds based on turnover. So if you have a small turnover in the country, it could be that you're exempt from having to register for VAT. The whole tax shift that I mentioned, the reverse charge thing, it does not apply locally to digital services if you're selling within the same country. You will have to charge VAT at local rates on your invoices, and you will also have to file local VAT returns. Now, moving on to B2C, this is a more complex situation. And it is because, as I mentioned earlier, consumers cannot comply with VAT. Now, the B2C digital services from the US into an international country For all of EU, they are taxable in the customer location. So how do we do that if the customer cannot declare the VAT? And you cannot do a tax shift either. There is no tax shift possible. Again, that applies just to B2B. That means you have to register, charge, and comply with VAT. Okay. So now, how do you do that? Okay. If you are just selling to one European Union country, you can just register there and start filing your VAT returns there. If you are selling to multiple European Union countries, there is this simplification in place, okay, which will facilitate compliance, okay? Because imagine if I'm selling to Italy, France, Germany, Hungary, all of these have different VAT rates, and I need to be charging different VAT rates on my invoices. But do I really have to file VAT returns and remit the VAT that I collect in all of those countries? No, you don't have to. There is this mini one-stop shop scheme, okay, the MOS scheme, where you simply register in one state under the MOS scheme and file one single MOS VAT return in respect of all the states where you have customers, okay? What happens then is that the respective portions of the VAT that you collect will be distributed among the member states as they apply to them, okay? So to sum up, I just have a diagram there. So imagine you're selling from the USA to Italy, which is a European Union country, digital services, SaaS, okay? This gives rise to VAT implications on the Italy side, okay? You need to apply 22% Italian VAT on your invoices. So the US provider needs a VAT registration in Italy and has to follow Italian VAT compliance, or if also selling to other EU states, to register and comply through the MOS simplification that I just mentioned. Going back to the B2B sale, no VAT is charged by the seller. VAT is simply self-charged by the purchaser, as we mentioned before. So that's a high-level view of the fundamental things that need to be considered from a VAT perspective. There will always be additional complexity, and it all has to be looked at on a country-by-country basis. For example, something I did not explicitly go into in this high-level overview are matters such as use and enjoyment rules, where you must determine where a service is really being consumed. So some European Union states would not subject a service to VAT if it is effectively used and enjoyed outside of European Union territory. But this depends on the countries involved, the specific service type provided, the customer type, and other factors. So nonetheless, it's one of the things that you should bear in mind, just in case it could have implications to your business. So that's all from me on VAT, and I'll hand back over to you, Gerald.
Okay, thank you everyone for that great presentation. I'd like to open the floor for questions at this point. Here's one. Let's start off by talking about European expansion. What are some of the areas that companies tend to overlook or underestimate when it comes to expanding in Europe?
Yeah, so this is Andrew Daly. I can take that one. I think obviously that's a big question, and something we could spend, I'm sure, with everyone on this call a lot of time, a day on. I would net it out in terms of our experience probably into three things. The first is in the area of payments. Most organizations assume that it's relatively easy to take payments, make payments, if necessary, across different countries and regions within the European Union. And when you get right down to it, particularly when you get into a B2C scenario or a B2B2C scenarios, you really have to look country by country and almost by payment method to really optimize your payments and minimize the amount of friction involved and the amount of cost involved as well. The second thing I would say is that, as we just heard from David and Petter, that the complexities from a tax and regulatory point of view are much greater than what most North American organizations are prepared to engage in. And that's only growing when you look at what's happening with Brexit and the UK's exit from the European Union. So I would say tax and regulatory issues are the second thing. And then I think the third thing is that just because your billing supplier, claims that it's multilingual, for example, or can handle multi-currency, when we do our analysis of billing systems, what you find is the requirements just from an invoicing point of view, from an invoice customization point of view, from a overall billing and rating capability point of view, there's a lot more complexity than organizations are prepared for, and frankly, that their U.S. systems or U.S. suppliers are necessarily ready for. So you really need the right partners in these areas, in payments and tax and billing, to be successful.
Fantastic. Thank you, Andrew. And to what extent are the VAT levels, or how high the VAT rates are, a consideration in deciding what countries to expand to?
I can take this one, and it's a good question, because the level of VAT is always relevant, because it is ultimately reflected in the price that purchasers are paying for the product. Okay, but we need to look at the B2B versus B2C. So in the case of B2B, the percentage rate, how high the VAT is less of a consideration, because as I mentioned in my presentation, VAT is tax neutral for businesses. So whatever they pay their suppliers in VAT, they reclaim back with their VAT return as input VAT. So essentially, whatever the VAT is on the price, the businesses aren't really paying it. It's the consumers, the end consumers, that are paying it. In the case of B2C, your price will always be increased by the VAT that applies in the country. So in short, to what extent are the levels relevant? For B2B, not so much. For B2C, a little bit more so.
Fantastic. And do professional services like those of lawyers, architects, or consultants qualify as digital services for VAT purposes if they are provided by electronic means?
That's also a good question. And in this case, no. Okay, so you need to look at the essence of the service being provided. Okay, SaaS generally, it is actually a software service. It is a digital service. It is actually the essence, the technology in the essence of what is being provided. However, if you're a lawyer, an architect, whatever, a consultant, and you're simply providing advice via email, which you could argue is by electronic means, it isn't an electronic service. It's a professional service that the rules for digital service do not apply to.
Okay, and another VAT-related question: in what way is sales tax different than VAT?
I think we could answer this from two different ways, from the sales tax perspective and from the VAT perspective. I'll take a crack at from the U.S. sales tax perspective. So unlike VAT, which is assessed at each stage of the purchase and production and paid by every successive buyer, sales tax is paid only once at the consummation of the sale by the final consumer. So it's strictly at the end, on the end user. I don't know, Peter, if you have any comments or thoughts on that one.
Yes, that's exactly what I was going to say. When people ask me about the basic difference, I say that it is the fact that VAT is applied at each stage of the supply chain, as opposed to just at the end. Perhaps something also to mention, which is something that you spoke about, David, in your presentation, is the multi-layered approach with US sales tax, that it applies at federal level, state level, and so on. What we see with VAT and GST, almost without exception, around the world, almost without exception, VAT tends to be just a national level tax.
Okay, let's switch gears here a little bit. How can I verify that I'm dealing with a business and should therefore follow B2B rules?
Yes, that's very important because as we spoke about in the presentation, that if it's a B2B transaction, you essentially are off the hook, so to speak, when it comes to VAT compliance. So you need to be really sure, because if you aren't dealing with a business, there are those obligations that kick in, which you must make sure to comply with if it is a B2C transaction. So the way you would do that, the most foolproof and immediate way to do that is to ask your customer to quote you their VAT registration number. Okay, there will be, if we're talking about the European Union, there will be ways to check the veracity of that number and the validity within European Union portals, but there are also solutions out there where you can run multiple checks on multiple VAT numbers that you have quoted that have been quoted to you by your customers. So there are other ways of checking, but my recommendation always asks for the VAT number.
Thanks, Peter. And what is the first step as a foreign seller that you need to do in order to be compliant with US tax?
Right, it's really the first assessment you need to make, and that would be, do you have Nexus in the US? And like we discussed, it could be from a number of different reasons, whether you have, whether you've opened up an office US, if you have a platform, so it may probably unlikely, but then you probably shift to an economic presence test of your sales within a given state, whether you've crossed that threshold.
And one more question for you. Is compliance purely at the state level in the US, or do local tax jurisdictions also come into play?
Sure, definitely localities come into play. It's multi-layered. So, and your tax rate will be comprised of several different components for one thing, depending on the jurisdiction. Like in New York, you could have a city sales tax, you'll have um, a county sales tax, you'll have a metropolitan surcharge on top of that layer as well. So there's multi-layered sales tax in U.S. And in terms of reporting reporting requirements and authority as well, with perhaps different tax rules at the state level, there's such a thing as home rule cities. So in Colorado, for example, there's over 50 cities that have really followed their, they have follow their own drummer. They are not beholden to follow state rules. They have their own ordinances, their own home rule authority to levy tax or sales tax. So it's a concept of home rule sales tax where you get away from, you're not even dealing with a state anymore. You're dealing directly with a city.
Okay, that should wrap up today's webinar. Tim, what are next steps here? How can we get in touch with your team?
Yeah, so I've posted my email on the slide deck here, as well as my phone number. Please feel free to reach out to me directly. I'm happy to put you in front of any of the resources that that have participated in this call, and we have many other resources to bear. Also, I posted the websites of the companies that have participated in the webinar today, so you can go there to find additional resources and information.
All right. Thank you, Tim. A big thank you to all of our presenters, and of course to all of you for attending today's event. To access this webinar on demand, please head over to channelvisionmag.com/webinars. Also, keep an eye out for a follow-up email from Channel Vision. Thanks, stay safe out there, and we'll see you next time. Take care, everyone.